Silver just got crushed. Take a look at this chart. Silver opened at $96. Within minutes of the open, it started sliding. It dropped all the way to $92. Then it fought back. Buyers stepped in. It climbed back to $96. It looked stable. It looked like the worst was over. And then, out of nowhere, it got slammed. A straight drop from $96 to $86, a $10 collapse, more than 10% wiped out in a single move. All of this while war headlines dominate the Middle East, missiles flying, the Strait of Hormuz under threat, extreme geopolitical tension, and yet silver falls 10% in one violent sweep after already recovering once. That is the kind of move designed to shake people out, to force emotional decisions, to make strong hands question themselves. So let me walk you through exactly what happened, why it happened, and most importantly, whether this is the buying opportunity of the decade or the beginning of something much worse. Stay with me, because today's data changes how you should see this entire move. But first, I need to address something. In my last video, I told you $5,400 was the line in the sand for gold. I said if gold reached $5,400, one of two things would happen. Either it breaks through and explodes higher, or it gets rejected hard. This morning, gold gapped up at the open. It jumped from $5,278 straight to $5,400. No trading in between. Just a vacuum. It even touched 5,118s, and then it got hit. Gold fell all the way back to 5,265s. The $5,400 resistance held. It rejected. That level mattered, and I called it. What I did not fully warn you about was how violent that rejection would be, and what it would do to silver. Now let's break this down clearly. 100 pluses gap at the open tells you something massive. That is not random buying. That is weekend fear being priced in. War headlines, missile footage, naval targets, embassy tensions. The market opened with over $100 of fear baked into one single print. When gold gaps directly into a major resistance level like that, there are only two outcomes. Either momentum blasts through and sellers get steamrolled, or sellers are waiting at that level with everything they have, and they slam it back down. Today was option 2. Gold touched 5,218s, and within hours was back at 5,265. The gap filled, fast, and ugly. But here's the key question. What does a rejection at $5,400 actually mean? Most people are reading it wrong. The lazy interpretation is gold failed, rally over, ceiling confirmed. That's noise. Here is the correct read. Gold was at $5,230 on Friday. Even after the $150 round trip, it is sitting around $5,300. It tested resistance, got pushed back, filled the gap, and is still holding above where it started. That is not collapse. That is a first attempt. And first attempts at major resistance almost always get rejected. What matters now is the second test. Does gold come back to $5,400 within days? Because historically, when a gap-up test gets rejected but price does not fall apart afterward, the second test often breaks through. The demand that created that $100 gap did not disappear. The geopolitical risk did not disappear. Buyers who stepped in on the gap may be underwater temporarily, but the reason they bought still exists. Meanwhile, the sellers who defended $5,400 just used serious ammunition to hold that level. They are not stronger now. They are more exposed. Now let's talk about silver, because that is where the real damage was. Silver fell from $96 to $86. In the same session, gold dropped about 3%. That is more than triple the percentage move. And this is the most important lesson about silver you can ever learn. Silver is gold's volatility amplifier. When gold surges, silver usually outperforms. But when gold gets rejected hard, silver gets punished twice as fast. Here's why. When gold gaps up $100 into resistance, it signals massive demand. But it also means there is no structural support underneath. No consolidation, no base, no trading volume between those levels, just air. So if the level rejects, price falls straight through the void until it reaches the last zone where real trading happened. That is exactly what happened today. Gold filled its gap back to $5,265, where actual volume existed. Silver did the same thing, but with leverage. It dropped through empty space until it found its previous support zone around $86. Gap fills after first resistance tests are normal. They look terrifying on a chart. They feel catastrophic in real time. But structurally, they are often healthy. Why? Because now the market has to build support properly. It has to trade at these levels, accumulate, form a base, let strong hands absorb supply. The first test of $5,400 was a raid. The second test, if it comes, will be a siege. And sieges break walls. Now the real question becomes, is silver building a base here? Or is liquidity drying up? That is what I'm watching next. And that will determine whether this drop was a gift or a warning. Here is your rewritten version. Tighter, clearer, and more powerful while keeping the same intensity. And understanding this will save you from panicking out of your position at the worst possible moment. Silver is a leveraged play on gold. It always has been. When gold rises 5%, silver often rises 10%, sometimes 15%. That's the part everyone loves. That's the part that gets the headlines. What people don't like to talk about is the other side of that leverage. When gold drops 3%, silver doesn't drop 3%. It drops 7%, 8%, sometimes 10%. It's the same leverage, just working in reverse. There is no switch you can flip to keep the upside multiplier and turn off the downside multiplier. They come together. That's the contract. Today, gold moved about 3% from high to low. Silver moved over 10%. That's roughly a 3 times amplification. Silver wasn't manipulated. It wasn't attacked by some mysterious force. It simply did what silver always does. It amplified the gold move. The same math that will make silver outperform gold 2 to 1 or 3 to 1 on the way up just punished it 3 to 1 on the way down. That's the deal. If you own silver, you have to make peace with that reality. Days like today are the price of admission for the days when silver rips 15% while gold only moves 5%. Now here's where it gets interesting. While COMEX silver was getting crushed, I pulled up the Shanghai price. On the Shanghai Futures Exchange, silver dropped about $5, roughly from 110 to around 104 to 105. COMEX dropped $10. Read that again. The physical market in the East sold off half as much as the paper market in the West. And during the crash, the gap between the two actually widened. Right now, Shanghai silver is sitting around 104 and change. COMEX is around 88. That's a $16 difference for the exact same metal. That premium had narrowed recently, and now it just blew wide open again. What does that tell you? It tells you the physical market is not participating in this sell-off the way the paper market is. The heavy selling is happening in futures contracts, in derivatives, in paper. But physical silver, the kind that has to be delivered, received, stored, used, barely moved in comparison. When the paper market crashes while the physical market holds firm, that is not a breakdown. That is a divergence. And divergences do not last forever. They get resolved. And historically, they resolve in the direction of the physical market. Because at the end of the day, you cannot eat a futures contract. You cannot wire a derivative into a solar panel. Physical demand sets the floor. And the physical market is telling a very different story than what COMEX printed today. Now let's talk about something almost nobody on social media is mentioning, the delivery data. March silver delivery notices show 306 contracts stood for delivery today. Each contract represents 5,000 ounces. Month to date, 4,846 contracts have stood for delivery. That equals 24.23 million ounces of physical silver demanded in just the first few days of the month. 24 million ounces. Now look at who's issuing and who's stopping. On the issuing side, firms like Macquarie and HSBC are putting metal out for delivery. On the receiving side, Bank of America, Citigroup, RBC Capital, they are taking delivery. Think about that. Silver just crashed over 10%. Price is sitting around $86. And major banks are accepting physical silver into their accounts during the panic. They're not dumping metal. They're accumulating it. That's not what you do if you think silver is about to collapse further. That's what you do if you believe the metal is discounted and you want as much of it as possible before the next move higher. Gold tells a similar story. March gold deliveries show 130 contracts stood today. Month-to-date totals 247 contracts, roughly 240,700 ounces. JP Morgan issued contracts. Bank of America stopped contracts during maximum volatility, during geopolitical escalation. While paper prices are swinging violently, big institutions are actively moving physical metal. They are not running away from gold and silver. They are running toward them. Now let's talk about something that made me laugh. Today, Bloomberg ran a headline, U.S. Treasuries fall as inflation angst eclipses haven buying. Read that carefully. U.S. Treasuries fell in the middle of a war, in the middle of global tension, in the kind of environment where for 50 years, everyone was told to buy government bonds. And instead, bonds went down. The explanation? Inflation fears from rising oil prices. The 2-year yield rose. The 10-year yield rose. European bonds fell. Inflation expectations jumped. Expected Fed rate cuts got pushed back. Here's what Bloomberg didn't say. They didn't say the obvious possibility. Maybe gold has replaced U.S. Treasuries as the safe haven, because that's exactly what just happened. Gold gapped up over $100 at the open. Treasuries fell. Over the past month, gold has surged. Treasuries have declined. Capital is flowing out of government paper and into metal. That's not just inflation angst. That looks like a structural shift. For decades, the playbook was simple. Crisis happens, buy treasuries. But what if that playbook just stopped working? Mainstream financial media cannot easily admit that gold may be replacing bonds as the ultimate safe haven, because the moment that narrative shifts, everything changes. Every pension fund, every sovereign wealth fund, every insurance portfolio overloaded with government bonds. They all have to ask a very uncomfortable question. If the world is breaking and bonds are falling, but gold is rising, why am I still holding the paper? Here is your rewritten version. Sharper, more structured, and powerful while keeping your conviction and intensity. And here's the part that ties everything together. The Federal Reserve is stuck. Rate cuts have been pushed to September. They can't cut rates right now because oil is surging. Cutting into an oil shock would pour gasoline on inflation. That's how you get inflation going nuclear. But they also can't hike. Hiking into a war-driven economy, where the consumer is already strained, risks slamming the system into a recession. So what do? They sit, they wait, they freeze. And gold loves paralysis. Gold thrives when the Fed has no good options, when every policy path creates more problems than it solves, when there is no clean solution. That is gold's sweet spot, and we are sitting directly in it. Now, what does Fed paralysis mean for silver? It means a weaker dollar. When the market senses that the Fed has lost control, that it can't tighten and can't ease, confidence in the dollar erodes. And when the dollar weakens, commodities priced in dollars become more expensive globally. Silver is priced in dollars. But silver is not just a monetary metal. It's also an industrial metal. Defense spending is rising. Energy infrastructure spending is rising. Governments are scrambling to secure supply chains. That requires industrial metals. The Fed cannot slow that spending without crushing growth. So demand continues, spending continues, the dollar softens, and silver gets pulled higher from both sides, monetary demand and industrial demand. That's not a short-term trade, that's a structural tailwind that can last months, and possibly years. And a 10% pullback on COMEX does not change that structural picture by even 1%. Now let me give you my honest read. No sugarcoating, no hype, just what the data says. Gold at 5,300 after rejecting 5,400 does not scare me. What would scare me is a sustained break below 5,000. Not a quick wick, not a flash crash, a real close below 5,000 that holds. That would signal a change in character. But a rejection at major resistance after a $100 gap up? That's textbook. First attempt fails, price consolidates, second attempt often breaks. I've seen that pattern countless times. Gold is still $70 above Friday's level. The gap fill did not turn into a collapse. It found support at 5,265 and bounced back to 5,300 quickly. That is not weakness. That is a market that wants higher prices but wasn't ready to break the wall on the first try. Every hour gold holds above 5,200, the base strengthens. And in this environment, catalysts don't take long to appear. When 5,400 gets tested again, and I believe it will, the sellers who already spent their ammunition defending the first assault will have less to throw at the second. Now let's talk silver. 85 to 86 is the level that matters. I'll be completely straight with you. That is the floor this move needs to hold. Silver bounced off 86 and is trading around 88. That bounce matters. Before this escalation, silver was in the low 70s. The war premium, the supply disruption premium, the Strait of Hormuz premium, all of that pushed silver from the 70s up to 96 in a staircase move. Now it has retraced roughly half of that advance. Half, not all. The war hasn't ended. Supply risks haven't vanished. Nothing fundamental has improved. If 85 holds, and I believe it will, then this is silver doing exactly what it always does after a parabolic move. It runs too far, too fast. Then it snaps back, then it builds a base, then it runs harder. That is the historical pattern of every major silver bull market. Run, pull back, consolidate, explode. But if 85 breaks on a daily close, I won't lie, that opens the door to the mid-70s, and that would shake out a lot of breakout buyers from the 90s. So 85 is the line I'm watching every hour. Here's what matters over the next few days. First, does gold retest 5,400 quickly? Fast retests after gap fills often break. Second, does the Shanghai premium stay around $16? If physical silver in the East holds near 105 while COMEX says 88, that divergence is screaming something important. Paper is weak, physical is strong, and gaps like that usually close toward physical strength. Third, delivery pace. 24 million ounces of silver demanded in the first few days of March. If that pace continues, this could be one of the largest delivery months in COMEX history. Large deliveries at lower prices are fuel. Metal leaving vaults tighten supply. Fourth, the war itself. The Strait of Hormuz is still disrupted. Escalations continue. Military assets remain in place. None of the geopolitical drivers behind the $100 gold gap have disappeared. The only thing that changed today was the paper price. Now let me tell you what would change my mind. I'm not a permabull. If the data shifts, I shift. Here's what I'm watching. If gold closes below 5,000 for more than 2 sessions, sustained, not a spike, that signals something fundamental changed. If the Shanghai premium disappears because Shanghai falls to meet COMEX rather than COMEX rising to meet Shanghai, that would mean the physical market is confirming the weakness. If delivery demand collapses, if banks stop taking metal, that would be a red flag. If a verified ceasefire happens and shipping lanes fully reopen, removing the war premium, that changes the equation. Right now, none of those things are happening. Gold is 5,300 after a gap fill. Silver bounced off 86. Shanghai still trades at a premium. Banks are still taking delivery. The war is still active. The Fed is still stuck. That's not a breakdown, that's a shakeout. And shakeouts are where the next leg higher is built. Now I want to speak to two groups. First, those of you who watched silver drop from 96 to 86 today. I know what that feels like. A $10 move in hours is violent, but ask yourself one question. Did anything about why you own silver change today? Did the conflict end? Did supply disruptions vanish? Did the physical premium disappear? Did banks stop taking delivery? No. The only thing that changed was the paper price. There is a massive difference between price volatility and fundamental change. Silver corrected violently because silver always corrects violently after vertical moves. If you sell here purely because of a red candle, you're handing metal to institutions accumulating during the panic. Now the second group, those who've been sitting on the sidelines asking, when is the dip? Here's your rewritten version. Cleaner, more controlled, but still powerful and confident. This is the dip. You've been asking for it. Here it is. Silver just dropped from 96 to 86. Gold pulled back from 5,400 to 5,065. The pullback people beg for in every bull market just showed up on your screen. And I already know what's going to happen. Most people won't act. They'll stare at the red candle and say, maybe it goes lower. Maybe silver hits 83, maybe 80. And maybe it does. But 6 weeks from now, if silver is back above 100, those same people will be saying, I should have bought at 86. I've seen this cycle play out over and over again. The dip arrives and fear wins. I'm not here to tell you what to do. I never do. But I'm telling you this. The dip you've been waiting for is here, and institutions are buying it aggressively. Do with that information what you will. In my last video, I said there would be mornings when gold is down $100 and social media would explode with panic. I said it word for word, and here we are. Gold is down over $100 from its overnight high. Silver dropped $10. Timelines are filled with "it's over" posts. And I'm telling you exactly what I told you before. It's not over, not even close. The rejection at 5,400 was a first attempt at major resistance. Silver's crash was leverage doing what leverage always does. The physical market did not break. Banks are still taking delivery. Geopolitical risk hasn't disappeared. And the next test of 5,400 is coming. When that level breaks, and I believe it will, silver at 86 is going to look like an opportunity most people were too afraid to take. So let me ask you, does 85 hold for silver? Does gold retest 5,400 this week? Did you buy the dip, or are you waiting for lower? Drop a comment, I want to hear where you stand. And share this message. There are people who bought silver in the 90s who are panicking right now because they don't understand the difference between paper price action and physical market strength. Paper and physical are telling two very different stories. Help them understand that before they sell at the worst possible time. If you're new here, go back and watch the last 3 videos. The 5,400 resistance call, the escalation call, the volatility call, it's all there. This is the hidden economy. Stay sharp, stay disciplined, stay stacking.